Welcome back to another Market Open live stream. Okay, today we have PCE numbers coming out. They're gonna be a big deal. They're gonna be such a huge deal. Mostly because Nick T thinks they're gonna come in low. And usually when Nick T leaks something, he's right. Now, who knows? Maybe this is the time the Fed's trying to say, you know, Nikki Leaks isn't Nikki Leaks. So we're going to leak him information that's not right. So it kind of softens the strength of the Nick T a little, right? But let's just put it this way. When you go to the tippy top of HouseHack, at the tippy top, what do you see? You see Nikki Leaks suggest PCE to come in low. Would you look at that? And why? It's because he believes that the most accurate of the forecasting bunch, like Citibank and some of the others that he chose, some of the other suits he's friends with, they believe that PCE will come in between 0 and 0.1. And they think that is going to be more accurate than the actual PCE core deflator month-over-month number, estimate of consensus of like 60 different economists of 0.2. So we'll know that within 3 minutes. We'll know, was Nick T right? It's kind of going to be cool to see. It's like the stakes are up, you know? Somebody just walked in and put it all on black, and it's kind of like, all right, win or lose, it's a show. So anyway, we have, in terms of economic outlook, we have, or estimates rather, we have 59 estimates on this PCE read here. 59. I would say the average estimate, actually, I don't even have to say the average. I can just read it out. Not, I would say. Delete, I would say. The average estimate is actually 0.15. The median estimate is 0.2. So we do kind of lean towards that lower side. That'll be really interesting. So we'll see what Nick T says here. Somebody over here says, looks like they're saying that Nike is tanking, and Kyle actually thinks this is a recording. Okay, very well. Well, if you go over here to HouseHack, you can see exactly why Nike is tanking, because I already covered that yesterday on HouseHack, which you would know if you went to HouseHack.com this morning. But anyway, look, Nike is the start of what I think is potentially that consumer recession of the lower 40%. This is the part of, I think, the cycle where that upper 40% starts making money in stocks and real estate and business again, and the cash flowing companies like the Microsofts and the Apples, they keep spending money, but that lower 40% starts getting whacked. I don't know that with certainty. I just see that from what I'm seeing at Ulta and now Nike, as well as some other consumer discretionaries. Some people would call Ulta a staple, but it's a discretionary. But anyway, Nike suggesting that there's a lot of promotional activity, and they're looking at the next quarter being slightly negative, and then maybe a little bit positive thereafter. You know, those are things that lead people to be a little nervous, let's just say. People start going, wait a second here. we thought Nike was a safe space. Oops. Anyway, bond yield's down about 4 bips right now, although I don't really recognize them as really being down because 3.85 sounds like it's exactly where we were like 2 days ago, so yeah. Anyway, let's get the data. Woo boy! What are we going to talk about today? I don't know. I'm adding more gold courses. We're filming gold courses. Make sure lectures, they're totally free. But if you want to join the gold course and all the course member lives, people love those. You got thousands of people who watch those every day. Go to meetkevin.com. All right, here we go. All right, durable good orders beat by 2, 5.4 versus 2.3. Wow. There's Nick T was right. Oh, no way. It comes in at 0.1. Oh my God, he was right. Whoa. PCE deflator year over year comes in at 2.6 versus 2.8. Deflator month over month comes in at negative 0.1 versus 0.0. Bro, no way. Oh my gosh, I was saying yesterday, imagine that number comes in negative. Okay. A PCE core year over year comes in at 3.2 versus 3.3. Oh my God! It just came through the prior revisions. They reduced the prior revision, the prior estimates as well. Oh my God, stop. No freaking way. Okay, PCE deflator month over month. It was supposed to be 0. It came in at negative 0.1. PCE deflator year over year was expected to be 2.8. It comes in at 2.6. And the prior of 3.0 got reduced to 2.9. Okay, then you have PCE core deflator, which was expected to be 0.2. It comes in at 0.1, just like Nick T said. The prior was 0.2. That also got cut to 0.1. Holy crap, dude. Oh my God. I should say gosh. PCE core deflator year over year. 3.3 expectation comes in at 3.2. That's lower, right? But then the 3.5 from the prior gets cut as well to 3.4. And this durable goods orders, okay, those are like washing machines and cars. Durable goods come in like twice, more than 2x the expectation. We're looking for 2.3% growth. What do we get? 5.4. What? More than twice what we expected? Durable goods X transportation comes in at, expectation was 0.1. We got 0.5. Capital good orders, non-defense, excluding planes, was expected to be 0.1. We got 0.8. It's probably because interest rates are coming down and people are like, ha, I've been waiting for this moment. Holy smoke-a-dopas. That, woo boy. Those are some big moments. Those are big numbers right there. I can't believe it. Nick T was right again. So how does that mean the market's moving? Oh, of course, down. Because that makes complete sense. Wow, though. So that's really going to move multivariate core down, right? Remember that multivariate core is going to, usually the estimate comes out on Mondays following PCE, but it's Monday's Christmas, so it'll probably be a little later, a few days later. Oh, this guy's gonna freak out. I want to see this guy freak.
All the way back, wow, to May of 2020 to find a higher number, but as I said, to some extent, it's kind of reversing what we saw last month. X transportation, we could really see what moved this number. It's all about transportation, aircraft, because now that 5.4 drops to half of 1%, 0.5%. However, that's still multiples better than we were expecting, and it follows a downward revision from unchanged to down 0.3, which also has a mean reverting factor there. That would be the best month-over-month change on its own at up 0.5%. Going to May of this year. And finally, if we look at capital good orders, non-defense X aircraft, a proxy for capital investment. Wow, this is a whopper too. Up 0.8%, up 0.8%. That is the best since it was up 0.9 in August. The problem is in between there, of course, we had some downward numbers. Last month's down 0.3 doubles to down 0.6. So even though there's some strong numbers in the durable goods, a lot of it is reversing some revisions that pushed us weaker last time. Net, well, on a 10-year, we moved from 385 to 387. Pre-opening Dow futures were down, I think, Joe, about 100.
The only explanation for some nervousness of people here could be that durable good orders are coming in strong. But you want that. You want that. If durable good orders come in weak, you're closer to recession. No. You don't, like, these numbers are freaking perfect. And well, I shouldn't say they're perfect because that implies that they're accurate. I'm not saying they're accurate. I'm saying they're perfect, as in they're good for us. It implies a stronger economy with less inflation. It's literally the best of both worlds. Like, if you came to me and said, Kevin, what is the best thing that could happen tomorrow? Well, less inflation and more production. It's not that freaking hard. Anyway, let's look at the actual PCE report. Personal income. Oh yeah, we also get personal income numbers. Personal income came in at, as expected, at 0.4. But personal spending actually came in at 0.2 versus the 0.3 expected. Anyway, personal... is this the last month report? Oh, this is last month. Darn it. Why? November 3rd. Okay, well, never mind. I still don't have the latest piece. You know, I've noticed that. The Bureau of Equalization, they are really slow at actually publishing the PCE. Oh, there it is. Okay, there we go. I don't know how they send it through the tapes that fast, and then they don't update their website that fast. It just came through. I got it. I like going through the actual document. But yeah, like, these numbers are good. It doesn't matter what the stock market did the first minute. It's like, let's be real. Those numbers are good. It'll go up. People will digest the information and the market will go up. Personal income increased 0.4%. We saw, okay, we got that. Disposable income increased 0.4%. Personal consumption increased 0.2%. There was a little bit of, this I will say was a 0.3 expected. PCE index decreased 0.1%. That's wait, PCE in that's the deflationary number. Yeah, but that's not the core number. And then I want to see if I can get some categories here where they say this occurred in. Personal outlays, personal savings. You know, I'm gonna have to get, I think, their charts and tables here. Yeah, I'm gonna do that really quick. All right, so let's get the charts and tables just to see where this weakness was. Oh yeah, I got it. Okay, yeah, baby. I can't believe it, Nick. Oh, there. Yeah, look at it. The first reaction, I'm like, bro, this is stupid. The market's getting it wrong. This is good news. And then finally. Okay, so let's go to the actual tableau. Come on. There you go. I got patience for these darn PDFs. Come on, man. By the way, if you ever want me to cover like a story or something you're seeing or a research piece or whatever, send me an email, kevin@ehack.com, and just put in the title, like, story to cover or research to cover or whatever. First thing I always do is I take a glance through my email, and I send back laughing emojis or whatever, or poop or eggplants. And so yeah, feel free to do that if you want, and then I can cover it in the Market Open Live. It's kind of fun. So, all right, what do we have over here? We have okay, seasonally adjusted annual rates. Well, I want the percentages, man. Give me, here we go. That looks better. Seasonally adjusted. Oh, that don't look much better either. Here we go. Okay, is it? Oh, man. Okay. So, billions of dollars. Those are changes in billions of dollars. Can I just get frickin' percentages? There we go. Seasonally adjusted at monthly rates. Thank goodness. All right. So here, this is a number that matters. Wages and salaries. Want to see those wages and salaries staying positive. Is this this is seasonally adjusted based on current dollar measures. Okay. So we want to see these positive, as they are. We hit 0.2 there in October, but wow, look at that 0.6 over here in November. Now, they don't mention that this is real, so if they don't mention that it's real, then we shouldn't assume it is. Yeah, here's real. I'd like to see, real is inflation adjusted, right? So can I get the month-over-month inflation adjusted? Real. Not for that much granular detail, apparently. You losers! Make the PCE great again. Come on. What is this? Real consumption expenditure. Okay, well, we already went through that. Fine. I'll have to take the non-inflation adjusted numbers over here. And so what we would do is we'd inflation adjust that. So, for example, if wages and salaries in November here are 0.6, and then what was CPI? CPI, which came out on, I think it was the 14th, it was like 0.3, right? Was it the 14th or the 13th? I don't know, I'll go back to like the 12th. Oh, there it is. It was the 12th. Yeah, so CPI core came in at 0.3. So then to get real for wages, you could just do 0.6 minus 0.3 equals 0.3, right? All right, so that's good. So that's real wage growth. We want to see that. Proprietors' income, so business owners, when negative. Yeah, that's very common in these cycles, that the smaller business owner having to pay higher interest rates is hurt more than the employees. The employees get wage increases, and the business owner, has to suffer all the poopies. But I mean, they chose to be the business owner, So it shouldn't be an us versus them. Everybody, you make the choice you want, right? You take the stress on that you want to take on. I mean, not always. Sometimes we are bestowed stress. But anyway, rental income of persons with capital consumption. I'm not entirely sure what that means. It makes me feel like it would be like rental property, but I'm not sure. Personal dividend income, 0.6. Personal interest income, 0.4, fine. Personal current transfers. Current transfer receipts, negative. So generally that would be like less from the government. Then we've got personal disposable income. We saw that. Yeah, you don't actually get too much granular data in this report. PCE, yeah, no, it's not incredibly useful in my opinion. Anyway, all right, so let's take a look at how the market's reacting. Or this guy, is he flailing again?
Inflation tool. Go to the website, look for the tool, and put in pre-COVID. Pick a month, January of 2020. And what you'll find is inflation's up 20% because it's compounded. These annualized rates aren't making people feel good.
Okay, they're playing. You'd probably like to say something, Steve, or I don't know, maybe not, but we'll have more time. This is like...
I love the guy's anger, man. I love it every morning.
Soon, hopefully. But thank you to the entire panel. Coming up, that guy, New York Times columnist Tom Friedman is going to join.
Oh, I heard New York Times. I'm just kidding. I actually don't have that much of a hate for the Times, although they have screwed up a lot. Wow. Okay. All right. Let's take a quick look to see how the market's reacting. Let's see what stocks are actually reacting off of this. So the Nasdaq was just like dumb and went down after this report, but then it quickly corrected course because that's just stupid. Obviously, your interest rate sensitive sectors are going to go up. Affirm's going up. You've got Micron going up on this. Damn it, Costco's up 13 basis points. I'm short. You've got Tesla up 0.95. Let's see here. Let's see here. Nvidia's up half. Nvidia's been like 490 forever. Like what? Look at that. Come on, man. Just break 500, would you? Just stop being a little pans here and break it. Like same thing for you, Tesla. Are you gonna get through 258 or not? Like you're just edging us here every single day. What is this? Coinbase up again. Google. What's going down? BTC. But yeah, BTC hasn't actually been behaving with the market much lately. It's a lot of enthusiasm about what's it called? The Bitcoin ETF. Not a lot that's actually heavily. Oh, Trade Desk. How interesting. 0.5% on Trade Desk. To the downside. Let me see if they reacted at all. No, like no reaction here. It might just be a lack of trading volumes. I mean, look at the volume on Trade Desk in the pre-market here. It's like 1 share, 10 shares. There was a 1,000 share candle there for a while, but basically no trading happening here. Intel's almost at $50. $50. Oh, let's go. Yeah, I've mentioned multiple times that if you're looking at an ETF in a pre-market, you don't understand how liquidity works. So watch. It instantly corrects itself when the market opens. Sometimes it takes like, yeah, there you go. Sometimes it takes like up to 10 minutes afterwards on a lower liquidity. But remember, exchange traded funds, like people think that you can manipulate an ETF. The only way you can manipulate an ETF is if you manipulate every single underlying holding. Like that's almost impossible. So people don't understand that. And this is why I say, just don't buy pre or post market. Liquidity is so bad pre or post market You're not working with market makers anymore who are creating liquidity. You're doing like direct trades basically through ECNs. It's stupid. There's so much less liquidity. You get ripped off in pre or post market usually. So be careful. I mean, unless you're trading very, very few shares, then it doesn't matter so much. Anyway, so what do we have here? We have affirm to, okay, yeah, end phase 125. Yeah, all right. What, Tesla bobbing around over here? Okay, there's nothing really exciting over here. How's Fair Isaac? Dude, still going up. Stop it. I'm never going to be able to buy it. Oh, well. Okay, so let's go ahead and see what some of the suits are saying this morning. Couple things some folks sent over. Kevin at ehack.com if you want to send me stuff. But I got a couple things people were wanting me to look at. Number one had to do with China. Okay, nobody knows China like not me. I don't know much about China, but I try to learn about China. But I thought this was very interesting. So here, they're really talking about slowing economic growth in China. It could basically limit China's hopes of being this independent technological powerhouse. And one of the reasons they say that is because the government is a disproportionately large share of what they call S&T spending, which is science and technology. And what's fascinating is they make this argument that, look at this, company sources of spending might make up somewhere around half of all the investment money that goes into, a corporation's science and technology spending, so 854, right? But the government makes up 53 through government grants, R&D tax incentives, 788 tax incentives, huge, absolutely huge in China. And then 108 government off-budget financing. I'm not entirely sure what that means, but I heard financing. So anyway, so if you add that together, you've got, let's see here, 53, 788 plus 108. That's 749. Add 854, and then do 854 divided by 1803, and what do you get? 47%. Corporations are only paying about 47%, whereas the government in this example here is paying about 53% of expenditures. And so you're potentially, the risk is, or the thesis here is, that maybe a lack of spending from China on S&T could actually slow down China's ability to innovate in the region. This, is eerily similar, by the way, to what I heard. There was a piece, I think it was in the Wall Street Journal. Tesla, we had the Tesla Megapack news, but which I'll touch on. But there was, I don't remember where I saw it. Tesla, China, something about how it's harder to basically expand in China because of these limitations of the government and the lack of support from the government. But it's very ironic because at the same time we hear that, Reuters is reporting the following. I'll give you a quick little snippet. Reuters reports that Tesla acquired land in Shanghai for a Megapack battery manufacturing production line. Or actually, not line, plant would be the better way to put it. Plant. And this was reported by Chinese media this morning. They are looking to make about 100, I'm sorry, let me get the math right. They're looking to make about up to 10,000, up to 10K megapacks here. Okay, that's a big deal. 10K megapacks. How much are they? They just dropped the price on the megapacks not that long ago. Let me see here. I'm still waiting for my Starlink, by the way. In 5 days, Elon will have had my $150,000 deposit for Starlink on my plane for a year. It's been a freaking year. And they emailed me last year. They're like, oh, it's time to deposit. We're getting close to installs. Bro, it's been a year. Damn you. So mega pack, if I do 1 mega pack, I'm looking at about 2 mil installed. Whoa, the install costs like $800,000. Oh, okay. So the mega pack itself is going to run around 1.2 to 1.3. So I'm going to go conservative here. I'm going to go with the lower number. I'm going to go with 1.2. Elon said China has more red tape for businesses than 10 years ago. Yeah, that's true. Have you looked at a 10-month core PCE annualized? Only 2 months to go until that becomes a year-over-year narrative? Yeah, no kidding. Yeah, no kidding. Okay, so, let's see here. Okay, the mega pack. I wanted to do this freaking math. God! Kevin, get it together. 10,000 times, I'm gonna go with a low number here, and we're gonna exclude installation. Duh. 10,000 times 1.2 million. Okay, that works out to I don't know, that's a lot of zeros. What the heck? Okay, so that would be $12 billion. I guess I could have just added the zeros myself. But anyway, $12 billion. That's, so that's 12 bill in potential rev, right? Let's say these batteries, by the way, have, like, they're called mega packs, not because they're big battery packs. They're called mega packs because there's mega margin in a battery pack. Let's look at Tesla's last energy margin filing. Although the they don't segment out batteries. They do segment out energy though, but energy does include solar panels as well, which is the lower margin segment of it. So I think on energy, their margin actually isn't that high. But let me see, energy and storage. But I'd like to see it segmented one day, divide those two things, because batteries should be closer to a 40% margin. But let's look here. So right now we're sitting at, on the month over month, or sorry, the quarter over quarter, 1559 in revenues, and the energy costs, 1178. Okay, so 1178 divided by 1559. Yeah, we're at about 24% margin on energy right now. Okay, so 24.5-ish % margin on energy now in last QQ. However, well, I should just say last Q. There we go. However, IMO batteries are likely closer to 40%. Solar weighs down. Okay, so let's go with 30% just for the giggles of math. If you go 30%, that's $4 billion. $4 billion. Okay, so 4 bills. Half yeah. Net income at Tesla was 1.878 for the last. So we're looking at maybe, if you call it, and then you had, in the 9 months ending, you had 7. So divided by 9, that puts you at about 7. Yeah, called it about $650 million of revenue per month, right? 650 mil, or net per month, usually. How much can $4 billion contribute? Well, 4,000 divided by 12. You could, oh wow, 10K mega packs could increase Tesla's current net by 50%. About 333 mil. Assuming we did that math right, your current monthly is about $650 million in net income. If you could do $4 billion of mega packs, yeah, net after your gross, and your COGS after your cost of goods sold. If you could bring 30% to the bottom line, bring that through OpEx, everything, you could increase Tesla's earnings by 50% with mega packs alone. That's nice. That's pretty good. That's pretty good. I could see JT here miss the ETF discussion. Still don't understand pre-market. All right. So anyway, all right, let's go ahead and evaluate now how the rest of the market is doing. So let's go to bonds is what I want to see first. Okay. Wow. See, yeah, like bond yields went up from where they were. We were down 4 basis points. Now they're at down 2. So it's a net movement up. Weird. Okay, let's go to let's see here. U.S. stock position heading into the end year boosted by valuations. What's remarkable about the positioning in U.S. stocks is that it's, well, that stocks are unremarkable heading into the holidays. Okay, so what's remarkable is unremarkability. Okay, anyway. So PCE came in line with risks sketched out earlier that it could come in lower. Had little impact on financial assets. The March cut was almost completely priced in. Even a lower print in core services, excluding housing, hasn't made a mark. Durable good orders were higher than expected, although some of the beat in core aggregates reflect downward revisions of the prior data. Today marks the last day in the office for many punters, so you've got to wonder if the price action will be dominated by cleaning up positions ahead of the holiday. That's funny. All right, let's listen in here.
In the first quarter.
And you're taking advantage of it how? Meaning, what are the things you'd be looking for? Are you in the? I don't know if you heard Bobby Kotick. He actually slipped it in very delicately. He said he thought the recession was going to be here next year. If that's the case, are there certain defensive stocks you'd be buying?
Yeah, we're in that same camp. I think a recession is definitely a possibility next year and a reasonable possibility. The consumer has weakened. We have not gotten through all of this commercial real estate challenges. And we're starting to see some signs in the labor market slowing a little bit. I think, Andrew, we got to take a step back here and remember the Fed wants to slow the economy down. They're trying to get inflation back in check. And it's an uphill battle for them with all the capital that's been thrown into the system coming off of COVID. And so the Fed will get what they want. They will slow the economy down. So the idea that we're going to perfectly teeter on the edge of Goldilocks might be a little optimistic. I do think right now we've had a nice run. It's been seasonal. Traditionally, we get the Santa Claus rally at the end of the year. And the first quarter tends to tell the tale on what's really happening in the economy. So where do you go? I think you go back to the growth-oriented stocks. I think large cap value looks great. I think this spread between 7 stocks and the rest of the market starts to correct. It has this month, and I think it does next year. I think we start to see new leadership next year. We want to invest in that.
So you don't hold. So those. Here's the question, though, for everybody who's sitting out there watching this, saying, "I'm an owner of the Magnificent Seven, and most of our viewers own at least some of them." Would you continue to hold, or you're saying you want out?
Well, no, what I'm saying is that what happens in times like this, where the Magnificent Seven, or back in the 1999, early 2000s, right, the hot tech stocks, what happens is they run and they run and they run, and people hold on to these securities like they're solid gold. You have to trim, Andrew. Bring your allocations back to neutral. Take some.
Okay, you bear.
Okay, to continue to hold them. They're great.
I'm not a paper hand.
Stories, but you just can't let them run away and take
once
allocations than they should. You have to be disciplined always in portfolios.
We want to thank you. We want to wish you happy holidays and look forward to a big new year ahead. I hope maybe there isn't. I hope you're a little wrong and maybe there isn't a recession, but we will see. Thanks.
Happy holidays.
All right, final check on the markets.
Hey, man, just because you try it once doesn't mean it defines you, okay?
Thank you. Happy holidays. Happy New Year. Lots of hugs. Hug your family.
No, honestly, he's not wrong. Like, you get stuff that goes loony bins and your stocks. It's probably not a bad idea to trim. Like, you look at like Coinbase, for example. You go loony bins on Coinbase stock. Is it a good idea to probably trim a little bit? Yeah, I actually think what Cathie Wood did was pretty right on. You know, she sold Tesla to buy Coinbase. Wasn't the biggest fan of that, but timing wise, Coinbase blew up during that time, probably because she had her meetings with the SEC. It's entirely possible that her meetings with the SEC convinced her that I think they had one meeting on their ETF with the SEC, convinced her that it was going to happen, and that's why she started dumping into Coinbase, which makes sense. You know, if you know the regulator's turning positive on your application or other people's application, that would make you very bullish. And then how do you express that in the stock market? Coinbase. So yeah, it's not a horrible idea to trim. It's overly simplified just to talk about paper handing, or not. Anyway, so wow, this PC, these numbers were amazing this morning. I want to see though what Doomburger has to say this morning, and see if they feel the same way, or if they've got any bad news for us.
That would be a huge risk into next year, growth being a much bigger one.
Can we get the best of both worlds? Can we get lower inflation and strong growth?
I don't really see any meaningful catalyst to sort of...
That's kind of what we got this morning. And these are little previews of things that have been said.
This is going to be the main driver of market.
Joining us now to discuss is Morgan Stanley's Michael Kushma and Mary Ann Bartels of Sanctuary Wealth. I just want to start with you, Mary Ann, about whether you're more worried about just a reignition of inflation or some sort of more material slowdown that looks weaker than people are expecting.
So going into 2024, we think inflation continues to go down. And in fact, I would not be surprised either in 2024 or in 2025, we actually go to a negative CPI. And I don't think that's being factored in. In terms of growth, when I'm analyzing the year-to-year change in real growth, it's actually improving. So I think it's actually possible you have inflation come down lower than people expect in 24 and have better growth. That's positive for earnings. That's positive for the equity market. Now, for the income market, in terms of fixed income, I think short term we can get a backup in rates because rates have moved. But I think if inflation continues to drop and the Fed begins cutting rates, rates are going to fall a lot lower than people expect. So we're calling the year of 2024 the bucking bull. I think people are going to be bucking the bull market in both bonds and stocks for 2024.
Yeah, that seems like a good guess, given the fact that that's what we've been looking at right now in terms of
bucking the bull. What?
It came in lower than expected. Michael Kushma, do you agree with that, this idea of immaculate disinflation on steroids with better growth and weaker inflation?
It does look pretty good at the moment. Inflation is coming down faster than expected, faster than the Fed expected, faster than I expected, faster than the market expected. And this sort of immaculate disinflation with growth stronger this year than it was in previous years, and inflation coming down sets the markets up for a very good 2024. The big question is, will
bucking the bull would be like diamond handing, I think, is a good analogy.
Expected. If financial conditions ease too much, maybe inflation doesn't fall. The economy does better than expected. People had forecasted a pretty weak 2024. This easing of financial conditions, which is taking us back to the levels of early this year, if not previous into 2020 and 2022, will be supportive of the economy next year when there's no real evidence of a significant slowdown. But most importantly, it's truncating the downside risk. It's truncating that significant hard landing, which people have been worried about for a year until the past couple of months. And that really bolsters the longer term. Whatever happens in 24 bolsters the longer term outlook for the economy and for inflation.
So how low can bond yields go in this sort of immaculate disinflation, even with the potential risk of the reignition of inflation, or at least that it remains stickier? Just because
it ain't gonna reignite.
Michael, do you see yields getting below 3.5% on a 10-year?
3.5% will be a difficult level to get through unless you believe that the Fed's terminal forecast about 2.5% is the long-term fair value for the Fed funds rate. If that is achieved, if that is correct, and we're on the path to get back to that 2.5%, then 3.5% is easily doable. If, however, the economy rebounds in 2024, inflation plateaus above 2%, then 3.5% will be very, very difficult and more likely to be 4%. going forward. So I think now we're getting to the critical juncture is how are things going to perform in the out years? We know interest rates are coming down in 2024. We don't know how much, but it'll be meaningful. 100, 150 basis points is easily doable, but farther out, are we going to get much below 4? That depends how the economy is perceived to perform in 25, 26.
Well, and then raises a question, Mary Ann, of whether you're going into some of these cyclicals, et cetera, and not necessarily betting as much on the bond space simply because it seems like the bucking bull theory of, yes, inflation coming in below expectations and growth remaining strong will keep alive some of those longer-term inflation goals.
So when I look at the 10-year Treasury yields, I just want to add, I think what people are not pricing in is that at some point, whether it's 24 or 25, the 10-year can go to 2.5. And I'm always looking for what is possible that the market is not expecting. And from technical analysis, 2.5% is actually doable. So if you actually do get in those inflation numbers down, I think that's going to be a huge surprise. And if rates continue to fall the way we think they can, that's really going to continue to ignite the equity market. Now, we're starting to see a broadening.
I think she's right.
To see what didn't work this year, like small caps, banks, and financials rally. But the question is, are those the new leadership? And we don't think that's where the new leadership is. We do think the market stays cyclical. We think the new emerging leadership is in the industrial space, leveraged into Biden's legislations that he's passed, which everybody's talked about, the CHIPS Act, the Infrastructure Act, and the Inflation Protection Act. But I think the true leadership in the market remains technology. And the pocket that we think sustains...
This is scary. It sounds too much like me. Confirmation bias. Ding, 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 ding.
They certainly can consolidate going into 2024, but I still see significant upside. In fact, they're just starting a new cycle. And when they start a new upcycle, it generally lasts for a couple of years. And in terms of the Magnificent Seven, they were actually supported by earnings. It wasn't air putting in wind sauce for these stocks. They actually produced the earnings just this year when the other stocks did not produce the earnings. So I do think that they can continue to participate, but you'll see that tech space actually broaden out.
All right, the Fed's preferred inflation gauge is cooling in November, just basically in tandem with what you both...
Yeah, I actually like this idea of the broadening out from basically the large cap 6-7. I think she's right about that. I don't think that's a horrible way to look at it. And I also think this analogy is very interesting. This idea of people basically, her phrase, bucking the bull, but the idea of like diamond handing basically your positions, because it's like, why would you sell? If you held through the past 2 years and the hell, or you just started acquiring, okay, yeah, maybe you trim a little bit here or there, but do you sell? Probably not.
Since February 2021. Meanwhile, you take a look at personal spending, rising 0.2% on a monthly basis, just below forecast.
We got to get Bucking the Bull Lady on the show.
You add that together, you have that sustained easing in inflation, you have still resilient household demand. It's giving a lot of juice to those who've been saying that there's a soft landing coming for this economy. Meanwhile, though, you take a look at the reaction in markets right now, it's not huge. You take a look at S&P 500 futures.
Yeah, the market isn't moving actually that much. Okay, so a couple questions here from the chat. One person still asking about the ETF thing. I guess they couldn't find it. I posted a little comment here. ETF liquidity is virtually non-existent in the pre-market for a smaller ETF. Come back 15 minutes after the market open and all the pre-market / post-market volatility will be gone. Yeah, let's see here. YouTube or only on X? I'm on everything. Thanks to StreamYard. This stream is brought to you by StreamYard. Check out metkevin.com/StreamYard to learn more. They're a paid sponsor of the channel. They let me put up comments. Look at this. I could put up X comments on YouTube through StreamYard. It's kind of cool. How are you playing Costco? Shorts or puts? Straight shorts. Puts, the volatility on Costco right now is absolutely insane. And when that volatility gets crushed down, you're going to lose a lot of money buying options, in my opinion, unless you get like a really big offsetting move. So I'm short, like just straight short on Costco. I'm pretty sure it's the only thing I'm short on. But I'll look at the volatility right now again, just to see if it started coming down. Barely. Yeah, the volatility, like the average vol is sitting around 20 for the 30, 50, and 100-day on Costco, it's at like 40, and it was at like 55. It's insane. You can't. The volatility is so insane right now. Let's see here. When you trim, doesn't the average price go up when adding later? Okay, the last thing you should do is think average price. It is so stupid. Like, if I ever have a brokerage app, I will delete the average cost button. You can calculate that yourself. I'll tell you why it's stupid. It's so stupid to care about average price because over the long run, prices go up. So what? Every time you add to a stock you believe in, your average price goes up, and then you make yourself feel bad. Like, I see people who bought Tesla in 2017, and they refuse to ever buy another single share of Tesla just because it'll move up their average cost basis, even though they believe Tesla's going to go up way more than other stocks. It's literally the definition of moronic. I'm not calling you moronic. I'm just saying, like, when you hear average price,
exceptionally strong credit performance was the probabilities of recession had dropped to not to zero, but to much lower levels, which allowed high yield to continue to do well. In particular, real interest rates for even risk-free assets are still on the high side, and that it should likely stay where they are or come down, but not go higher, which will be supportive for the economy and supportive for risk assets in general. So high yield is definitely a lot more expensive than it was. I don't expect a lot more spread tightening, but on the other hand,
yeah, this high yield idea, by the way, is this idea that there's appetite to some extent for debt that's going to prop yields over at hedge funds or whoever's buying the higher yield debt, the risky debt, so to speak. Have you factored in the gold hype with Costco? Yeah, actually I have. So Costco basically sold you gold bars. It was like a limit 2 per customer or whatever. They can't make a lot of margin on this. My guess is that they probably make somewhere around 1%, maybe $30 of margin on these things. So that would be between $20 to $30 of margin, since gold's around $2,000. There's not a lot of margin in gold. It's very expensive to ship around. It's what it is, and the reason they have, like, think about it. If it were really profitable for Costco to sell gold, they'd sell you more of it. The reason they put a limit is because it's ridiculously expensive and it's low profit. So what they're trying to do is they're trying to get you to buy the Costco membership. It's like an advertisement, right? But selling gold, like, don't get me wrong, there's margin to be made on it, but it's generally a lot smaller than people think. So yes, there could be gold hype that'll end up fading away. Let's see what Riding the Bull has to say.
Because although we see inflation coming down this year, we think over time inflation is going to reaccelerate, and that eventually yields
I don't like her anymore.
Up again. And you want to be able to have that steady stream of securities maturing, so when rates do back up, you can lock those in.
Michael Kushma, Marianne Bartels, both of you are sticking with us. Let's take a look right now at what is moving.
I mean, in fairness, she thinks inflation's going to go negative. Yes, don't worry. They will print money to make it go back to 2% if it goes negative. I can't wait for the days the money printer comes on again. Questions. Bears call for inflation to tick up if rates drop. Rates were near zero for the last 12 years with 2% inflation. Wrong. Rates were near zero for the last 12 years with 1.75% inflation. It's even worse. Anyway, I think it's just the last straw for the Bears. What do you think? Yeah, look, capitalism equals deflation. I'm never gonna get off that horse unless it's proven wrong, and it's not, and it hasn't been. History, like, if people are always like, oh, just look at history. History, repeats itself. Yes, look at history. Look at 1955. Look at the mid-90s. Look for your post-Korean War soft landing. Look at how inflation comes down as capitalism expands. So simple.
Nike
All right, this is all boring. This is some boring intro stuff. All right, I think we got another stream here. Does that mean DCA is a scam and doesn't exist? No. DCA is totally fine. Dollar cost averaging is fine. Dollar cost averaging is the exact opposite of worrying about your average cost basis. Don't be emotional, Kevin. What? You have to accept different opinions. No, I don't. I could listen to your other opinions, but I don't have to listen to them or accept them rather. That's what I mean. Okay. All right. So, oh, isn't this a Bitcoin commercial?
You know what's interesting these days? Bitcoin. Look for Bitwise, my friends.
It's back. The crypto ads are back. Oh my gosh. Okay. All right. Oh man. All right. So where were we? Here's an interesting piece. I got Piper Sandler piece I got sent. Current dynamics favor bond buying. Now, I thought this was interesting, too. Over the last 40 years, the Fed has embarked on 5 easing cycles. 89, 95, soft landing, 01, 07, 2019. During these periods, the economy experienced 4 recessions, with one instance in 1995 being called a soft landing. First of all, let's be a little clear about that easing cycle of 2019. Would we have had a recession? Oops, I'm trying to draw right there. Would we have had a recession if it hadn't been for COVID? Like, is it fair to say that the 2019 easing cycle led to a recession when COVID created the recession? Now, some people say, well, a recession would have happened anyway, but it's not that clear. It is much more clear that you had a recession in 89, 01, and 07. So actually, if you want to look at the last 5 easing cycles, only 3 out of 5 were led to clear recessions. I think you have to adjust for that, which means 60% of the time, you have a 60-40 split here. 60% of the time you had a clear recession, 40% of the time you didn't have a clear recession linked to a loosening cycle. So this idea that 4 out of 5 times, I actually think is misleading. Current environment presents a convincing opportunity for investing in bonds. I actually agree with that. Not personalized advice for you, but just like broad advice. See, I'm allowed to do that. Broad advice. I think buying bonds is a great opportunity, mostly because you're locking in higher yields at a risk-free rate, and you potentially have a chunk of capital appreciation ahead of you if you don't hold to, maturity. Then you just have the yield ahead of you. So very interesting. Bonds right now, okay, down 3.4 bips. We did a big HIMS analysis in the course member live. I don't remember what I thought about them. Long live crypto, says Canducey Corbett. Interesting. All right. Wow, Kevin fell off on that one. What, Mitch? Historically, in the 3 months leading up to the Fed's initial rate cut in each of these these easing cycles, there has always been a consistent trend of declining interest rates across the yield curve. This pattern was observed both in periods leading to recessions and the 95 soft landing scenario. Similarities, interest rate movements in these economic phases are noteworthy, blah, blah, blah. Basically, I think a good conclusion they give is right here. Whether the prevailing economic outlook results in recession or another soft landing, historical trends indicate that bond yields tend to fall in both cases, which means whether you get a soft landing or not, bond yields tend to go down in both scenarios. See, it's a really interesting analogy because initially it's like we're trying to dispute or find like a disagreement or whatever, but I 100% agree with him. In all cases, bond yields trend down. So we should write that down. In all cases, though, bond yields trend down and likely will. Hashtag no guarantees. So let's go here and make that actually a legible text. There we go. There we go. Like I said, if you want to send any researcher pieces to react to, send them over to. Like, you see something interesting, you're like, oh, I want to hear Kevin's opinion on it. Especially bear pieces. Come on, give me some bear pieces. Send them over. Kevin@ehack.com. So funny. Min is another person who's missed 2 different ETF discussions that we had, and that's A, and B, doesn't understand how pre-market works. It's okay. I understand there's a lot of learning to do in the stock market. That's why we have the Stocks and Psychology of Money course over at meetkevin.com, or the Gold course with new lectures coming out at the end of this year. Excited to film those. It's, you know, during the holidays, the office goes really quiet, so I get to do a lot of catch-up work, which is always fun. Okay, what else do we have here? Belgian court rules Deliveroo couriers should be classed as employees. All right. It takes the whole side hustle thing away from people. A recent poll suggests the head of the hard right alternative, I don't see them as like super hard right, okay, is more popular than Olaf Scholz. That blonde lady is really popular right now. Like, if you're paying at all attention to German politics, this Alice Weidel, I think is how it's said. Alice Weidel. Wait, Weidel. E and I makes I. Weidel. So it'd be Weidel. Alice Weidel, I think. Anyway, this lady is like, she's like so viral right now in Germany. She's absolutely kicking butt. She's 44, and yeah, she's pretty straight to the point, and people really appreciate her. Mostly because she's right now really digging in on the anti-immigration movement, which a lot of Germans very pissed off about the number of refugees who have been taken in, and how they say the Deutsche Kultur is changing. The German culture is shifting and changing because of mass immigration of basically refugees. And so you have this massive movement in Germany that is essentially trying to counter the mass immigration movement. Flüchtlinge. See, Flüchtlinge right here in the back means refugee. Flüchtlinge. And then they put her right in front of it. Like that, again, yeah, that's one of the big things. But anyway, that doesn't surprise me that she's more popular than Olaf Scholz right now. The whole of Europe is up in arms. They've been hoodwinked, says somebody. Bob says, all over the world, Kevin, it's not just Europe. Isn't there a far-right uprising in Germany? Well, you're referring to the ADF? No, it's AfD. Sorry, I always mess that up. Alternative für Deutschland. That's I don't actually think they should be considered far right. I think they're just they're definitely more on the conservative side. But that's usually what happens, is the mainstream media says everything to the right of them is the far right. But some people say she is far right. Okay. Trautüte. I don't know what a Trautüte is. Trautüte. I don't know what that is. Translate German to English. Trautüte. Like tear bag? Tüte? It doesn't even translate. Tran is like tear. It must be tear bag. Sounds funny if it is. Ivanka Trump 2024. Dude, she is so over politics. There's no way, man. No way, dude. Europe right is not the US right. Well, yeah, of course. Let's see. Make Germany great again. You should go on German news channel. Honestly, my German is way too weak to go on any kind of German news. Although I have been on, Teabag. Teabag? Tan? How is it? No. I've never heard of tea. Tea is tea. No. Okay, Trantüte. I've never heard of that in my life. But anyway, yeah, my German is not good enough to go on the German news. Although I have been on the German news before when I was running for governor in California. My German is nowhere near the level it needs to be to like, I listen to the people on the news in Germany, I'm like, oh wow, okay, those are some big words. Yeah. All right. Boy, a lot of comments here. Living in Switzerland, so right next to Germany, I can say AfD is definitely far right. Close relationship to the Nazi movements. Oh my god. Okay, we got some. Scott says, "Warum?" Andrew says, I think it's funny when Kevin Virtue signals he's an immigrant from Germany. When did I say I was an immigrant from Germany? Like, when in the last 5 minutes of us talking about Germany, did I once say I'm from Germany? I did not say that once. Like, I think people wake up and they wake up. You know what it is? The coffee hasn't hit them yet. So the coffee doesn't hit them yet. And they wake up and they're like, shit, my shorts are down again. I'm gonna go blame that perma-bull, which isn't true either, but that's what they think. I'm gonna go blame that perma-bull. And then they have to finger. They're like the person we had. Oh, I shouldn't say it. Well, we had to deal with somebody yesterday who was kind of like blowing us off, and it was pissing us off. And their typing on the computer was this. And we're like, bro. Anyway, so all right. Let's focus here. So what do we got? Yields down 3.3%. Honestly, 3.3 bips. The yield should be down way more than that. Let's look at the 5-year break. Let's look at the 5-year break, and let's look at what the market's pricing in for cuts. Oh, the world interest rate probability curve. We haven't looked at that one in a little bit. So let's look at that because that's always an interesting look for trading as well. Dude, it's straight down. Oh, wow. And then the 5-year break even's been, you know, it's up, but it's stable at about 2.19. I'd like to see that a little lower. Let's see here. So these comments are hilarious. Oh, yeah. Bernanke era underwear index. Hermes or Hanes brand HBI still at lows under $5. I haven't heard of that, but it would be interesting. Because I don't think your ability to keep apparel prices high is going to work well. But anyway, here's the 5-year break even. And here, let me hide myself. You can see that we've ticked up from that 210 low here. And we actually ticked up after J-Pow signaled cuts. So this uptick was straight after Jerome Powell signaled cuts. So the market priced in a little bit. Does that mean inflation could go up a little? That's a good one. Toughen Kevin live. Meet Kevin live. That's funny. All right. Here's the world interest rate probability curve. The world interest rate probability curve is implied over. I mean, this basically just indicates which direction we're going to go. And we are looking at, by the end of 2024, 6.5 rate cuts. On the right side, it's hard to read, but on the right side, you have number of cuts. And on the left side, you have where that would leave you at about 3.75. So, and as you can see, this curve it doesn't actually inflect to like a slower rate until over here roughly, but it's roughly straight down. And no, Bob, I argue some of the bulls as well, bro. Bear thesis. The Fed does not need to cut rates to stimulate demand. They just did via expectations on cuts. How does this not stimulate demand? I actually think it does. In fact, I think the Fed's signal of rate cuts coming is one of the reasons durable good orders just beat by a factor of 2. And by more than 2. Durable good orders came in at 5.4%. The expectation was 2.3. And that includes cars and planes and washing machines and all that good stuff. I think the reason you saw that is because interest rates are starting to flex down.
If you're not in that particular space.
Ooh, we got a Frankfurt person in here. That's awesome. Frankfurt!
Buy your stock. But maybe there's going to be more deals to be had in this space as well.
Yeah, Amgen's interesting. Yeah, Scott mentions today's call, upgraded by Daiwa yesterday and BMO the day before that. Three positive calls on Amgen just this week. But it's definitely about the companies that have stuck to their knitting, in diabetes especially. And Lily's the prime example there. Let's get the opening bell and the CNBC Real-Time Exchange. And the big board, it's SP Funds, celebrating its S&P Global Technology.
Where are the cheers? SP Funds has no cheering.
Building technology company celebrating its recent IPO as we try to get back to 4760. Dow getting...
It's dead quiet. They don't... Come on, man. Like, you gotta... Like what we did. We invited course members to the New York Stock Exchange. We had like 150 people there when we rang the bell. And it was like... We were alive. Squandered opportunity. All right. Let's see. Dang it, Costco's up again. Come on. Where was I? Oh, I was gonna push this button. Let's see what's happening here. All right. Tesla's gonna try to test 258 again. Let's see if it can pull it off today. I think there's a huge technical moment that happens right at 258. Because you've got this massive downtrend and the Fibby right there at 258. End phase is teetering on negative here. See what happens there. You've got the Qs moving up, 0.38. Costco's moving up. Affirm's up a couple percent, although it seems to be rotating down here. Intuit, trying to go down. S&P's trying to go up. Nvidia's trying to go up. First Solar's going down. Google's going up. Oh, what? It's going to be our big 7 again? Big 6? Microsoft's flat. Trade Desk down. And let's sort by percentage here. So what do we have? Percentage change movements. Owlet down 6. Trade Desk down 2. These aren't big movements to the downside. Where's Nike, though? I want to see Nike's movement. That's what I was looking for. Nike. 11%. Trying to recover, though. It's actually trying to move up here in the pre-market, or the or right after the bell, rather, just post bell, and down about 10.8% here. How is that affecting Foot Locker? Let's take a peek at them. Foot Locker. Vincent, you missed the Tesla analysis. Hector says, you didn't pick me for ringing the bell. I'm sorry, Hector. Next one. Foot Locker's down 9%. Oh, pure sympathy play right here. All right, let's go on what the suits are saying. Bond investors sell the fact on dying inflation? What, are they moving the stocks or what? The bond market's reaction today to today's softer than forecast PCE deflator is a classic buy the rumor, sell the fact type of trade. Okay, yeah, that's fair. Add to that the large beat in durable goods, and bond investors are likely to continue to take profits today. Inflation is dying. Core personal consumption expenditures price index, the Fed's favorite inflation gauge, stripping out. Okay, we already covered all that. That's interesting. So they're basically saying the bond move today, which is weird that we barely had rates move, was just buy the rumor, sell the news, and that maybe when people come back to work after this holiday, we'll actually see some more movement in stocks and bonds. This is actually the last market open live through Christmas. So I won't see you again until I think Boxing Day. Well, that's kind of sad. But I wish you all a Merry Christmas. We're not done yet. We still got stuff to cover. But yeah, that's fascinating. So yeah, I'll see you Tuesday. All right. So what else here? This is a very interesting headline. Trump eyes long shot woo more black voters than any Republican. Okay, but we're not going to go politics right here. We're going to go interesting. Look at this. Here's an interesting one. Euphoria on Fed pivot. Ignores lagging hangover. What's the lagging hangover? Let's think about it. The bottom line is the Fed hikes are biting and will continue to in 2024. I mean, that is true. Restrictiveness is not going to go away anytime soon. But the reason I'm not so worried about that is mostly because I believe the market is forward-looking. And the market is trying to look through for about, probably about 18 months ahead, which I think is very interesting. Adam, we're on Webull right now. When are you going to call for warrants? Actually, possibly January or February. 2 258 reject on Tesla. I totally believe that. Yeah, look at that. Perfect. Literally to the dot, folks. To the dot. 258 reject on Tesla. Wow. Makes sense. I mean, if I had limits to sell, 258 until it breaks. What you could do is you could set a limit sell at 258. And then you could set like a limit buy or whatever at 259, because the thesis would be that a stop order, but the thesis would be that if it breaks, because if you set a limit, it obviously gets executed on the buy, so you have to set stop. But anyway, if it breaks 259. The thesis, and you don't execute until it breaks 259, right? The thesis would be that if we get above that, it just explodes. So I know some people are setting up trades like that. Okay, good. So then we've got, question now is whether central banks have underestimated the threat of inflation. No. If anything, they're probably over-tightened. Citigroup earlier this year found that the deterioration in credit availability shown in the U.S. and Euro area lending service could lower real growth in bond regions 1% to 2% next year. Yeah, that's the big question: is it possible that growth is just way lower than expected, right? Like this is actually probably a very, very reasonable bear argument right here. Is that earnings will keep the market honest? 100% agree. And I think there'll be some nervous, like I'm a little nervous about Q1 earnings, not gonna lie, unless you get some like really good forecasts going into the new year. Yeah, not heavily enthused. Let me listen here for a moment what they're saying.
Adding some surcharges on these diversions. We had the CEO on Money Movers earlier in the week. He said it might be adding 2 to 4 weeks delay. IKEA is a good example. They mentioned it.
This is the Red Sea problem.
But that's at this moment. We'll see whether or not that 2 to 4 weeks delay timeline gets expanded if this gets worse.
Yeah, there doesn't seem to be much on inside here, although energy is the strongest performing sector today, at 0.7% right now. Consumer discretionary is the laggard there.
And then you have Buffett.
Yep, that's what I expect. Yeah, Brent just broke $80. Dang it. We generally don't want to see oil go up, and we want these Red Sea issues to go away. I wrote on HouseHack that I actually think that it'll take about a week or so for U.S. defensive ships and destroyers to really get into position against the Houthis. And once that occurs, I think we'll see a lot more rapid stability in the transport market, especially as we start getting and transporting by escort some of these container ships through the Bab al-Mandeb Strait. And that has me thinking that this trade issue will be a little bit more temporary than other people think. Of course, can't make any guarantees on that. That's just a thesis. Do you have a pie chart of what your holdings are? Curious percent Tesla. Ooh, we could make one. But no, I don't have one handy. All right, let's listen over here.
I'm a FOMO kind of guy, and we all laugh.
Thanks, Susan, for joining. Welcome.
Way to go this year. Are you still a FOMO kind of guy?
I am, and I...
George Williams says nothing he's saying makes sense. George, have another glass of wine from your profile picture.
It's a market that is really appreciating peak inflation over a year ago, peak interest rates, peak tightening, and historically that sets up a good backdrop for risk assets. It's hard to find an environment where markets did not do well over the subsequent years after peak inflation. And this seems to be very similar to that. It actually is quite reminiscent of the early 80s when we broke inflation and many didn't believe it to be true, and yet the markets did very well over the subsequent years.
So the recent rally doesn't worry you? I mean, I feel a little bit like Grinch because every time people come on and they're really positive and they talk about immaculate disinflation and everything going well and people keeping their jobs and us not having to experience pain, which is a wonderful thing. I think about, well, what if we get reignition of inflation? What about Nike? Is there going to be weakness?
That's the bigger concern. Like, I will be very transparent. If you are a bear, I will give you the best bear arguments. 10-2 inversion. Earnings. That's it. I have a hard time beating those two. So The best bear arguments tend to, and in earnings. Reigniting inflation, not a historically significant one.
Happen. And so what will likely happen is you'll see broader market participation in the beginning of the year, much better than just the Magnificent Seven and very concentrated markets. At some point, the lagged effects of all of this tightening starts to happen and we slow down. I remind people that equities tend to do well in a slowdown. You tend to want to shift towards higher quality rather than, the riskiest names. But I think the concern is around that slowdown. Do investors start to fear that a recession is forming? It doesn't seem likely, again, given the fundamental strength of the economy. But all years have pullbacks. And if you do get a pullback in the middle of 24 or later in 24, amid slowdown concerns, it likely represents another buying opportunity.
Which is what we've been hearing forever.
Wow, this is really interesting. Look at this. We did Max just pointed it out. We did our course member live stream on Ulta, and we analyzed Ulta on the 19th, which is actually after earnings. We analyzed them on the 19th, and we've got thousands of people who watch the course member live streams on a daily basis where we do, actual like fundamental analysis. And we go deep into these companies. And Ulta, since then, has started rotating down. Like I'm kind of holding that. You can see that there at about that 490 level. That was the 19th. Down since then. Personally, I think Ulta's going at least down to those moving averages. At least to those moving averages. So we'll see. But yeah, that's another one. Ulta, maybe I should have shorted Ulta, not Costco. But honestly, it's probably not too late to short Ulta. Maybe that would be a balance out Ulta and Costco on the shorts. But yeah, both of those going into the next couple earnings, I'm interested in. People freaking out over here on Tesla. And no, we're still at 257. Oh, it's trying. It's trying. Yeah, it doesn't break until you close some candlesticks, and usually the 5-minute is what matters, not so much the single-minute chart.
The market's clearly not euphoric yet, and again, I come back to the simple point that markets tend to do well in the aftermath of peak inflation and policy easing.
You said that it's important for people to lock it in, and we were thinking earlier this year, are you going to be worried more about the reinvestment risk or the preservation of cash risk? Are you saying that still at 3.85% on a 10-year, 3.86%, that it's still a good buy, that you could still see yields going materially lower from here?
No, I don't think materially lower. I think for, investors who were begging for 4% in 2019, and we had to say, look, you have to go out into high yield bonds to get 4%. I mean, today that you can get close to 4% in a treasury or own a core bond strategy.
Opportunity cost, bro. It ain't that freaking hard. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. Oh, look at Coinbase. Holy smokers, man. Straight up on Coinbase. Wow. Okay, I'm going to go make a cup of coffee. Join me in the course member live stream. The cheapest way to get in is just buy the gold course. Go to meetkevin.com, buy the gold course. You get lifetime access. I literally have live streams going back to like 2017. We actually had a course member email us that he's going through all of the 2019, 2018 real estate analysis we did, just so they could learn everything on exactly how I buy real estate or stock analysis during COVID, whatever. Pretty amazing. But anyway, check that out. Price will be going up Jan 1, and we're adding more content to it. So I'm going to make another cup of coffee really quick. Thanks so much for being here. Appreciate y'all. And thank you so much, Urban X. Buy the course. Totally worth it, they say. Thank you.